How do you avoid value traps? Hi, my name is Gary Mashuris. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I was recently asked, what about value traps and how do you avoid them? Well, let's figure out what do we mean? What's a value trap? Well, I think usually when people talk about value traps, they're talking about the buy a stock and it doesn't go up or it goes down and it was cheap to begin with, but it still doesn't work, right? So that's a value trap, meaning it was cheap, it looked like it should be an attractive stock, but it didn't do well. So I actually think that most of the time when people say something is a value trap, it's really that they made a mistake valuing the company. Because remember, you can have a cheap stock that's actually not undervalued. And just because something is statistically cheap on last year's earnings, on last year's free cash flow, or your estimates or whatever, you can be wrong, right? So a lot of times I think people want to say, oh, it's a value trap because they don't want to say, hey, I was wrong. I misvalued this business. Now, there are two types of mistakes. One is you got the whole value range wrong. You said, let's say you said the value range from worst case being 50 to best case being 150, with a base case being 100, and it turns out that the business is worth 40, below your worst case. That's a big mistake. Or more importantly, it turns out that the business is likely value range based on the available information at the time, if you had fully done your work, was much lower than you thought. That's a mistake. That's an important mistake, and you should try to really avoid that. Another kind of situation is, let's say, same scenario, value range from 50 to 150 with a base case of 100, but now it turns out the business is worth 80. Well, that might have been just a little bit of bad luck, right? You have a value range for a reason because you don't know for sure what the value of a business is. And maybe, just a bad set of circumstances came together. Let's say, for instance, you were assessing a drug company. You had an expected value for their pipeline based on your research and probabilities. And let's say more than their fair share of their drugs failed. It doesn't mean that the expected value was wrong. It just means that, unexpected things happen. Now, in there, if you purchase the stock with a margin of safety, you probably shouldn't lose very much money, or you might even make some money. Because let's say you thought business was worth 100 in the base case and you bought it for 50 or 60. Well, now if it's worth 80, you still do okay. Now, let's talk about a different version of value trap. Is you buy a cheap stock and it stays cheap and it just doesn't move. You buy a stock at 6, 7 times earnings. I have one of those in the portfolio, and nothing is happening. Now, it's not that the fundamentals are bad. The fundamentals aren't giving you indication that your value assessment was wrong, but the market just doesn't want to recognize it, which is, I think, what a lot of people also refer to as a value trap. Well, here, I think it's really important to have a good management team. Let's say you are right, and this business, instead of being worth 7 times earnings, let's say you think it's a growing business, should be worth 15 times earnings, just to use an example, or more than double where the stock is trading. Well, if you have a decent business that's generating a lot of free cash flow, and you have a management team that knows what they're doing, you would expect them to add value meaningfully by buying back shares. In that scenario, if the stock is trading at 7 times earnings and 7 times free cash flow, they can grow earnings at 15% per year or more just by using all the free cash flow to buy back shares and reducing the share count. So it's not going to take very many years for either for there to be very few shares left, and the stock is very unlikely to grow from 7 times earnings to 2 times earnings, right? So it's more likely than not to go up, at least at the rate of the earnings growth, or for the market to recognize their mistake and revalue the business, especially since now you're going to have fewer shares outstanding. Now, if you have a bad management team or one that's just mediocre, and they're sitting there and they're saying, "Oh, we're going to be extra cautious, and yes, our shares are cheap. We're not going to buy any of them because of, well, we don't know, but we're just not going to do it. We're going to talk to the board," or whatever excuse they give. And the stock is cheap, but it's not going up. Yeah, it can stay cheap for a long time. But look, at the end of the day, value investing works on average over time, right? So maybe you have one or two of those circumstances in your portfolio, but it's very unlikely. And the way you can skew against having those scenarios play out is by having above average management teams that know how to allocate capital, which means that they shouldn't let a stock be permanently undervalued for years and years if they're generating free cash flow and they can do something about it. So I think the important thing here is to make sure when you talk about value traps that you're honest with yourself about did you get the value assessment of the business wrong? And also when you're talking about the version of value trap where the fundamentals are tracking just fine, but the stock stayed cheap, that you have a management team you can count on to add value through capital allocation. I hope that's been useful to you. And if you like this video, please hit like and subscribe to the YouTube channel. Thank you guys.